All right, so I formally welcome you today. Last week, we did one question based on this discount rate based valuation of equity assets. And we took the example of General Motors that if they are likely to pay dividend $2 next year, and you expect that the stock price of GM would be $58, and the required rate of return, this is the CAPM return. When the word come required rate of return, it means this is the hurdle rate. This is the bare minimum rate of return which the company would promise to give to its investors. So in this case, because sometimes it happened that you cannot be asked to calculate CAPM based calculations first and then use valuation, the question can be too big. So in this case, in this example, for the sake of simplicity, they have already given us the rate of return, the required rate of return, okay? But unless you know that the required rate of return is CAPM rate of return, you may still be confused. So always remember that the required rate of return is the CAPM determined rate of return. And the actual rate of return can be different from the required rate of return. Remember yesterday when we calculated Finnair's actual rate of return, I remember, and you can confirm from the video which I posted on YouTube now, and the link is in Moodle already. The actual rate of return was 6.86 something. And when we use the CAPM model for Finnair, the rate of return was not more than 3%, less than 3%. So CAPM determined the required rate was about 3.4%, rather less than 3%, and the actual rate of return was 6.8 something. So it means that the actual performance was more than the expected performance. And the difference between these two things is called what? Do you remember yesterday? Huh? Jensen's alpha. Jensen's alpha shows that how far are the actual performance and the expected performance varying. Like, for example, if I expect that in my class, so-and-so student would be getting not more than 70 marks. This is my expectation, that 70 is the limit. But when I see the result, the student has got 100 out of 100. So the actual performance is exceeding way more. But same way, it can also happen other way around. My expectations are very high. I expect that this student will not get less than 5 grades and student get only 3. So the Jensen alpha can also be negative. So it works both ways. So as long as you know what is required rate of return, you know the benchmark, you know that who you compare with. Once again, I give the example of the hurdle race. We don't know how high you should jump to win, but that bar tells you that, hey, you must jump over it to get the gold medal. In the high jump, somebody can say, oh, I can jump very high, but you must jump over the bar. So the bar is the minimum, benchmark. And this bar, in this case, is the capital asset pricing model determined required rate of return. So, yeah. So we continue one more example, but I want to first say a bit nutshell of what we found last week. And then we calculate what is the fair / theoretical / notional price of GM now. And when we applied this formula, you get dividend in the first year, and you also get the price when you sell the stock. And when you combine these two things, divide by the rate of discount to the power of 1, because in this case, we took only 1 year, it came to be 54.55. It means 54.55 should be the fair price of GM. But now, if you look, 54.55 is the fair price. If you look at let's imagine that the GM's price was actually 60. Okay, then you could say that GM is overpriced. And if the market price was below it, then you could say that GM is underpriced. So depending upon, we need two things to compare. So that is very important. And we have one more sum here, example. The current stock price of Daimler Chrysler it's listed in New York Stock Exchange, is 44.70. This is the current price now, right now. Now the market price. You expect a dividend of 2.08 in 1 year. So you know what is D1 because it's in 1 year, so we call it D1. You forecast the stock price to be 49 in 1 year. So the expected stock price is 49. If you purchase this stock, DCX is its ticker number, the code number. At the current market price, what return do you expect to earn over a year? So in this case, you need to calculate one missing number, which is the rate of return, R. So you know that how much dividend you will be getting. You know the likely price and you know the current price as well. So if you put all of them, then only one missing figure is R, rate of discount. So it means that 14.27 is the expected rate of return, which include two things. It includes the capital appreciation and the expected dividend yield. Why would I invest in a stock? Because I'm expecting two things to get. I'm expecting that there would be dividend yield next year, and also there would be appreciation in my capital asset. Appreciation means you never buy shares now so that they become cheaper next time. You always want to see appreciation, not depreciation. Right? Make sense? But do you want, as an investor, do you even feel happy if you expect depreciation in the future? Or you always expect appreciation? If you short sell, well said. If you are short selling, means you sell now, but you promise to buy in the future, then you would be praying that, hey, the price should fall so that you can buy it cheaper and clear your position. Well said. So in case of short selling, you may expect to hope that the capital asset, the financial asset would depreciate. But in the traditional trading, buy first, sell later, you hope to have appreciation. There's one more. For the next 5 years, the annual dividend of a stock are expected to be the figures are given 2, 210, 220, 350, 375. In addition, the stock price is expected to be $40 in 5 years if the cost of equity is 10%. This is what, again, CAPM comes in picture, yeah? Make sense? What is the value of the stock? So once again, you want to find the value now, so you need to discount them back, and you add all the dividend flows. $2 divided by 1.10 to the power of 1. Why 1? Because it's in the first year. 210 you divide by 1.10, which is the rate of discount. To the power, you square it because it's 2 years. So depending upon how far you are waiting, you put the power, the time, as an exponent. Here you see that the power of 5 comes 2 times. Do you know why so?
5 years.
Here 1.10 to the power of 5, and here again 1.10 to the power of 5. Why so?
Expected stock price in 5 years.
Exactly. So for the first year, you have 1 cash inflow, dividend. Second year, 1 cash inflow. Third year, 1 cash inflow. Fourth year, 1 cash inflow. But when your investment period is over, 5th year, you will get 2 cash inflows. Number 1, you will get get the dividend as such, plus you expect to sell the stock at $40. So you get two in cash inflows in the last year. Well said, Ivan. So that is why here 1.10 to the power of 5 is coming twice. It's like when you deposit the money for 1 year with the bank, then at the end of 1 year, you get the interest plus your whole principal money back. So you get two cash inflows. The same thing happens here. And when you do this all calculation, it comes to be 34.76, okay? 34.76 is the total cash inflow you will be getting from this investment. The 5 dividend have a total value, but if you only calculate this much, look at the cursor where it's moving. Ignore this last figure. Then the present value of all the future dividend cash stream would be 9.926. Okay. Yeah, and only stock value would be 24.837. So you can actually split up this thing. 34.76 is the total value of this. But if you only focus on the dividend stream, then the present value of cash inflow would be 9.926 of dividends. So the only value which belongs to the stock would be then 24.83. So you can do this basic operations. It's not too complicated. Here you can see that I think I told you that we use this symbol sigma if we have to make some addition. Okay. And DT is the dividend which you get, the cash stream in the future plus the rate of discount. And T can be from one period to infinite period. It could be possible that your investment is for many years, long period. Okay. Usually it should be N, not infinity. N means there should be some terminal point when your investment horizon is over. But there are some investments which go on. You continue. If not the same stock, but you sell something, but at the same time you buy something. So you choose to be the client of a broker company forever. You get my point? So it could be possible that you sell something, but then you buy something. So it could be possible that you keep in the investment mode all the time. Alternative definitions of the term cash flow. As I wrote here, the dividend discount model defines cash flow as the dividend as an investor. But the problem is that will you only study those companies who are giving you dividends? There are companies who do not give you dividend. So does it mean that you will not include those companies in the calculation? A company might not pay dividends on its stock for good reasons or the bad reasons. The good reason, first let me tell you the bad reason. The bad reason is that the company is so unprofitable that it doesn't have money to pay dividend. The good reason is that the company is seeing a huge prospects of the future growth. And rather than giving money to the investors back, it is reinvesting the money for the future R&D, market research, product development, exploring new markets. They are now having their operations in Africa, in Asia, in Latin America, far away in Oceania. So they are going far away, or they have started new businesses. So there can be some good reasons or the bad reasons. Sometimes, in fact, investors feel very bad if you give them dividends. Because giving dividend by a growth company is a sign that, hey, we are no longer growth company. You get my point? If Apple start giving dividend to its investors, investors can start decoding from it that why is Apple giving me dividend? Hey, maybe they don't have good nice NPV projects where they could maximize the shareholders' value. So sometimes giving dividend invites a bad reaction. If you are an old-fashioned, old economy company, then giving a periodic dividend is a ritual. You must give, because if you don't give, people would be very unhappy, investors. But if there is a growth company and it's consistently now giving dividends, this could be viewed as a very negative thing. I remember Microsoft didn't give dividend for over 10 years. Nobody complained. But now it gives. Maybe it's no longer as growth company as it used to be. Yeah. Of course, there is a life cycle. You can never remain like human beings can never remain young all the time. We can pretend to be young, but the age catches up. Same way, the company is also pretending to be the forever perpetual growth company, but it never happened. There's always a, when you become more mature and more steady, kind of, yeah. Okay, so the company is mature and they have some lesser attractive investment opportunities. And this is the case for many companies. And many companies, which I gave the examples, they are or they will be in that phase when they start behaving like a mature company. Non-dividend paying company. So we take one example of valuation of the stock of a company. Let's say it's Yahoo or Google or Microsoft, the non-dividend company, for example. Assume that ABC Incorporation has not paid a dividend and is not expected to pay even in the near future. So it doesn't pay a dividend, and hopefully it will not pay in the next few years. If the company starts paying dividend, so at some stage when its growth cycle goes down, it is expected. Look at the word expected. This is very confusing. That is why the word, the role of behavior and the feelings and the emotions and the sentiments are very important in the financial markets. You can say that the company would start paying dividend based on the fact that some of its competitors have started paying dividend and they are paying this much dividend. So you can say that because the company is of the same size, same business, all these things combined, then you can make some good hypothecation, some estimation that if this company start paying dividend, it will also pay this much. Or you can also adjust it for the future growth rate that maybe this company, you can even do this way that, hey, if an investor have a capital gain, what is capital gain? If you buy some stock for $20 and you sell for $30 in 1 year, your capital gain is how much? $10. Capital, gain on capital, come on. You buy a house for 200,000 euros and you sold it for 250,000 euros in 1 year. Capital gain, 50,000. Okay, so if you think that your capital gain in 5 years on this stock is not giving you any dividend, but you know that there would be 50% increase in your investment in 5 years. Okay, so then you can imagine that if you split 50 by 5, 10%. Okay, so then you can estimate that the company would give you 10% dividend if it starts giving dividend. So this way you can make some estimation, some guesswork. Okay, whatever methodology they adopt, if the company start paying a dividend of $1, not now, but 5 years from now, and then it is expected to grow at 5% from then. So first of all, company is not paying dividend now. It won't pay next year, not even the following year. It will only pay, hopefully, dividend in the 5th year. And how much? $1. But then onwards, if it starts paying dividend, then it becomes a habit. And then onwards, the dividend would grow at 5% each year. So in the 6th year, they would get 5% more than $1, which means $1.05. Then the future dividend stream can be discounted back using the dividend discount model, of course, and assume that the CAPM rate of return is 11%. Yeah. So what we do then? Look at that. The value of the stock in the fourth year. Look, here I didn't put zero. Did I put zero here? Now, if I take D1 here, not 5, but 1, then this is 0. 1 period less. Yeah. So if fifth year is a dividend, then the fourth year is a period before. So what we do here, we put D5, the dividend which you get in the fifth year, divide by R. What is R? The discount rate minus G, the growth rate of dividend. This is the formula as per the dividend discount model, that you divide the dividend by R. R, I hope you know the rate of discount, the CAPM rate minus the growth rate. And that would give what? That would give us 16.67. It means what? It means that the expected price of this company's stock in the fourth year is how much? 16.67. And if you know the fourth year price, look, by using the same methodology, you can calculate the stock price today. So discount it even backwards. So from fifth year, you discount for fourth year, and from fourth year, you discount back to year 0 now. Same methodology, it means that 10.98 should be the fair price of this stock. Is it? But be careful about this phrase R, the rate of discount, which is the required rate of return, which is the CAPM rate of return, and G is the rate at which the company stock can grow. And this is, as I said, this is the Gordon's model we use, basically. But I have something to ask you here. Do you see any problem with this formula? When you only see this part, do you see any problem? Any mathematical problem which can arise?
Right.
Huh? Okay, we put the brackets, no problem. But any other problem you see?
Multiplied in the number of years.
No, because here, look, we did here, because here we jump from fourth year to 0 year, but here, no, it's fine, it's okay. Any problem you notice?
So it's for the fourth year, but we're considering the price of the fifth year.
No, but R minus G is used as discount rate. So we are discounting it a year before. R minus G. What if G is more than R? Then the stock price would be negative. Negative means, well, of course, in mathematics, negative is possible, but in reality, there is nothing negative. Means 0, basically. Negative means 0. So it means that the company's stock price would be nothing. Absolutely 0. The company is no longer existing because the value of its stock price is 0. Is it sensible? You think that the mathematical issue R minus G, if negative, can you justify this negativity, possible negativity from your statements? Can you give some arguments? Obviously, if G is more than R, it means that the company is giving, it may be considered that the company is giving too much dividend than what it can afford. And that's the truth, that if a company is paying too much of dividend, then it will become bankrupt eventually. You see what? Life is all about how you start your first move. If you give less dividend, if your dividend growth is less and slowly it goes up, I can understand that the investors would be very pleased. But if you start giving dividend, a lot of dividend, and then you start reducing it, investors would be very unhappy with it. I mean, if you make them used to of accepting high percentage of dividend, and then you start slashing the rate of dividend, it will be a negative thing. So even in the real life, not just mathematically, but even in the reality, G exceeding R means the company is paying excessive dividend. Is not a good sign. And that can lead to the stock price, the complete collapsation of the prices. Is this point understandable or not? Yes or no? R, the minimum return which you must give to the investor, which they must get from the company. G, dividend. The rate of growth of the company stock. And remember, dividend is a component of the overall rate of growth. You have seen in the previous example, the dividend was only a part of the complete package. We also include stock price in it. But if the dividend is increasing way faster than the increase in the stock price, it becomes unsustainable for the company to run the operations. So that is why even in the real life, this R minus G is true if R is more than G. But if G is more than R, then it could be a problem because, yeah.
It can still be for a short term, right?
It can also be for a short term. But if a company's stock price becomes zero, then even that short term could have very long.
Bigger growth.
Well, then in that case, if the companies look, in a way, it's a very natural justice. In a way, it's a very self-determined mechanism, defense mechanism. How? If a company is giving too much of dividend, yeah, the company would become a risky company, basically. Because the analyst would say that, hey, why this company is paying so much of dividend? Are they not using this money for the growth in the future? And because of more riskiness, what would happen? The beta would go up. And when the beta would go up, then this R would also go up. So maybe possible that at low level of G, R is also low, but higher at least. And as the G becomes larger, R also become larger, but still remain higher than G. Make sense? Because if a company is paying too much of dividend, there's an excessive growth in dividend, then that would also impact the riskiness of the company. And when the company become more risky, the beta goes up, then R would also go up. So that way they are quite much connected. So that is why it's very unlikely that this term would become negative. Yeah. Any increase in G would have a knock-on impact on R as well. Good point, Yanni. The Gordon growth model, which basically we have discussed already, it's a very famous article which was published in Review of Economics and Statistics in 1959. It's one of the classics in the field of finance. I have to check. I think I have this article somewhere in my folders. Forecasted dividend is assumed to be growing at a constant rate. So we assume that the dividend is growing at a constant rate. See the scenario. This article was published in 1959. At that time, the dividends used to grow at a constant rate. Even now, in many companies, in the traditional companies, you would notice that the dividend, the year they have too much of profit, great performance year, they don't give exceedingly high dividend. The year they make a horrible performance, they don't start cutting dividend. So dividend is more like a, sometimes we have a question. In fact, it can be very good thesis topic, that how much dividend is in sync with the company's performance. I can give you dozens of examples when the company was almost sinking, but it was still paying dividends. And when the company was making a big increase in the market, they were making a mark of them. The company was not increasing its dividend itself. It was giving somewhat, but not in proportion to the success of the company. Yeah, it's reasonable. You're right. The reasoning is that when you are doing great job, okay, because see what, again, it's a behavior. You can't pay too much and then pay less next time, because then people are expecting even more from you. So you have to be very careful. And plus, when you are in the good time, then you create a buffer. Buffer means you create some extra resources, use them, keep them saved like your bank account, and use that money if the company is giving a bad performance. So you use that as a safety cushion, basically. Yeah. Like many countries who sell oil, they keep that money safe. They don't use it because we have a country next door, not far away from it. Whatever sales it does through oil, it saves. Do you know that country, Fernanda? Anyone? Norway. Yes. So it's like creating a financial cushion, safety net. All right. G is the growth rate. Dividend is in the last year, DT -1. G is, as I said, the growth rate of dividend, and DT is the expected dividend and in time T. Suppose that the most recent dividend was 10 euros. Then if we forecast a 5% growth rate in the dividend, then we would be having an expected dividend to be, just apply the high school mathematics unitary method, would be $10.5. So just a simple, if you are getting $10 now and you expect to get 5% more next time, then it will be 10.5. So at the 5th year, if it keeps increasing at 5%, then it would be your initial dividend now, D0, plus 1 plus growth rate to the power of 5. So you can expect that at the end of 5th year, you would be getting 12.67 euros in the form of dividends. So you can create your dividend stream. And if you want to find the value of your stock based on the dividend growth model, then it would be dividend now plus 1 plus growth rate, divide by what? The rate of discount. Why rate of discount comes? Because this dividend you expect to get after 1 year. Make sense? And when are you evaluating? You're evaluating now. Here, the same thing, but to the power of 2. Because this dividend you get after 2nd year, at the end of year 2. And here again, to the power of 2, because the rate of discount. So this goes on, and eventually you are able to develop a formula. If this time period is infinite, then your formula becomes this one. It means the value of the stock is equal to dividend you get now, the dividend you get at the end of year one or the period one is divided by R minus G, whereas R is the rate of discount, which come from CAPM, and G is the growth rate of dividend. So there is a logic. The reason I think you may not be so much interested in mathematics, but I can tell you why it happens, is that here there's a power of 1, power of 2, power of n number of years, and then it could be even more. And why this formula becomes this one? Because if the power of n, if n becomes infinite, yeah, anything to the power of infinity is 0. So many terms disappear, and eventually you are left with this formula. Okay, so D1, the dividend you expect in period 1, divided by R minus G. Both equations are equivalent if, well, there is no increase, but usually R is more than G. If R is less than G, the equation as a compact formula, so it's not valid. But we discussed why it's very unlikely. And I wrote here that if R is less than G, it means that dividend grow faster than they are discounted. So the value of the stock is infinite. Of course, infinite value do not make any economic sense because then it basically means 0. Okay, so that is my whole point, which we discussed. And then we have some examples. We can do that. Let's do that. A required rate of return on JC Penney stock is 8.8%, which is a CAPM. Okay. On examination, you believe a stable growth rate of dividend at 6% is a good description of the long-term prospects. And the company's current dividend is 50 cents. Yeah. So apply the Gordon growth model and calculate the fair value of the stock. So we know that the current dividend is how much? 50 cents. And it is likely to grow at 6%. So we apply 50 to multiply by 1.06. So next year, the dividend is expected to be 53 cents. Divide by the difference between discount rate and the growth rate of dividend. And it comes to be 18.93. So it means that 18.93 is the fair value of the company stock. This is the intrinsic value, but the market price, when we check, is $25. So you can say that JC Penney stock now is overpriced. Overpriced means it's far more than what it should be. And many investors would visualize that, hey, you can't sustain this overpricedness, this anomaly forever. So before it goes down, if you have JC Penney stock, sell it. You see what? Let me share it with you, actually. Then it's easy to understand. Yeah. If we have time here, we are measuring time. It could be daily, weekly, monthly, yearly, whatever. And we know that by using the dividend discount model, the price is 18.93. The intrinsic or the theoretical price, but actually the price has been moving around the average. Remember, in this case, 18.93, which is a theoretical price, I can also call it an average expected price, the average price. But actually, the real price has been going, is above it. This discrepancy between the reality are these lines, and the theory is called anomaly. We use the word anomaly, that something is unfairness in the market. Either the market is treating this company too favorably or too unfavorably. In either case, it's a deviation, it's an anomaly. And we also believe that unless you are in a very backward market where things are very old fashioned, in the modern day markets, these anomalies do exist, but they are correcting very fast. It means that if something is overpriced, it's very likely to be at the equilibrium price soon. And if something is underpriced, it's going to go up and once again reach the equilibrium soon. This anomaly exists in every market in the world, but in the more advanced markets, the timing duration of this anomaly is very small. Whereas in a relatively less advanced markets, this anomaly remains for a very long time. So if this anomaly exists in New York Stock Exchange, for example, then you can expect that in the near future, the stock price will go down if it is overpriced. So what you should do then, offboard sooner, sell it sooner. And if you find that there is a downward anomaly, the market is treating somewhat unfairly what this company deserves to be, then you buy it because then it's likely to go up soon. So you have to be very quick in decision making. So this word anomaly, I wanted to bring to your notice that the discrepancy, the gap between the reality and the theory is called discrepancy or anomaly. Yep. Right.
Isn't it so that some of the companies, like certain industries, are always overvalued? If the assets are mostly intangible, for example, I would reckon that they are basically overvalued compared to their.
But you're only talking about those companies whose intellectual capital has proven to be a success. But what about those companies who are still working on their intellectual capital? If you're working in a software now and you go to Nordea and ask for the loan, they would never give you. But if your software has been a success, they would be chasing you. Hey, can you move from Danske to us? Yeah.
What is going to happen in the future? You don't know. You can actually say that if it's overvalued, but if it's, for example, Apple or Facebook, it might still, go up. Doesn't necessarily go towards the real value of the company.
Well, eventually it goes. For example, Microsoft stock has been very much overpriced for a very long period.
Longer period.
Yeah, no, I mean, if you, for example, it could be so that, see, it depends upon your investment horizon. If your horizon is 1 year or 2 years, you could say that, hey, it was overpriced in first year. It was overpriced even more in second year and even more in third, fourth, fifth year. But if you are having a long-term perspective, you can say that, you know what, in the 10th year, it turned to be normal. So it depends in what period you see. Like when you see on Yahoo Finance, on any stocks, you can see that if you are only considering day or week, market graph is showing you strange indicators. But if you think about a month or 6 months or a year, then the same thing turns up. Depend upon your how long you are in the. Are you going to have long-term stay with the market or the short-term stay? Yeah. But it depends upon, you're right, it depends upon some industries and sectors also. We're living, well, in the first quarter of the 90s decade to the third quarter of 90s decade. So 1993, 92 rather, to 1997. If you look at the IT companies in the US, when you would be alarmed, people would believe that, hey, the stock market can never crash. The stock prices can never fall. Investors can never be poor. And then you look at 2007 crisis, and you would tend to believe that, hey, stock market would never revive. Investors would never have those good old days. And then came COVID-19. Initial reaction was very bad, but slowly you would see that, hey, how on earth, when the economies are crashing, but the stock markets are still doing good? So this is the very funny part, or you can say very sinister part of the financial markets.
The same in the Great Depression.
Huh?
The same in the Great Depression in the past. Great Depression in
Yeah.
the US.
Yeah. Yeah.
Was
Yes. And if you look at 2001, the early phase of this 21st century, the US corporate sector was totally crippled by the corporate bankruptcies. One company after another company becoming bankrupt, Enron, Adelphia, Northern Rock, so on and so forth. In a span of two, 3, 4 years, the big giants fell. And that was because they were doing corruption. Yeah, that is a part of our second keyword in our track, corporate governance. We haven't touched corporate governance yet, but we will do it soon. Yeah, but first I want to have next and the following week this SPSS workshop. I would be very relieved after I do this workshop, because it's very important that you learn some strong quantitative skills with the real situation. Right. Something similar. We have one more example. I want to maybe bring to you. In this case, the rate of discount is not given to you. Can you see that? In this case, you have to calculate a rate of discount. How? By using CAPM. But all the ingredients of CAPM are given. So this way or that way, you will be finding the information. Suppose a company has a beta 1.1. The risk-free rate is 5.6%. Where on earth anybody gives 5.6% nowadays? Maybe some funny island somewhere, in Arabian Sea. The risk-free rate is 5.6%, and the market risk premium is 6%. Do you remember in CAPM we used yesterday this kind of expression? Let me first show it to you, then I'll come back to this slide. If you remember, CAPM was the required return on asset is equal to risk-free rate plus beta times the return on the index or the market return minus risk-free rate. I forgot to tell you one thing yesterday, that this term in the bracket RM minus RF is also called risk premium. My bad, I didn't tell you. This RM minus RF is also called risk premium. Okay. And why we call it risk premium? Because it could be possible that somebody is willing to invest in the government securities at 1%, Whereas in the stock market, the person is expecting 6%. So why is so that this guy is satisfied at 1% here and 6% at here? So it means you are compensating, if not bribing, you are compensating this person 5% extra to move away from risk-free to risky investment. So that is why it's called risk premium. Okay, so I go back to the, because this word has been used in the slide, so I thought I should share with you. Share the slide again. Yeah, so it means here, the risk premium is the gap between market RM, the market index rate of return, minus RF, the risk-free rate. Yeah. The current dividend is $2, is expected to grow at 5%. Okay, fine. What is the value of the company's stock? The price of stock, the actual price, the market price is $40. And what dividend growth rate would be required to justify? Okay, all right, we'll come back to the second part later. But let's find first the current value, the intrinsic value or the theoretical value of the stock. First of all, calculate R using CAPM. So risk-free rate plus beta times RM minus RF, risk premium is given here. So it's 12.2. So the rate of discount is 12.2 and the dividend is going to grow at 5%. Okay, so it's positive, the difference. So D1, the dividend is 2 now, expected to grow at 1 point. So it means in the next year, the dividend would be 2.10. If the current dividend is 2 and the rate of growth is 5%, then the expected dividend is 2.10 divided by the difference between R minus G, and it comes to be 29.17. So the intrinsic value is below the market value. In other words, the stock is overpriced. Then the question is that if the stock price is if the stock is overpriced, what type of adjustments you can bring to the discount rate that it become equal? So then the question is that, see what? Try to visualize, imagine that you calculate V0, it comes to be 40. And then the real price is also 40. It means the rate of discount which you're using is absolutely in sync with the reality. But if your actual price is below, the theoretical price is below and the actual price is more, it means that you might have applied very strict discount rate. So some adjustment needs to be done in the rate of discount. And that's what we are thinking here. So in that case, look here, assuming that your current dividend is 2, the CAPM rate of return is 12.2, the growth rate in dividend have to justify. So what happened is that, so 2 plus 1 plus G, so find the value of G. Does it make sense or not? Because see what, this formulation is based on, I think Shiny would be not so happy if I don't do it. And if I do it on whiteboard, Shiny would be even unhappy. Shiny? So what I'm going to do is, I'm going to do this calculation on the whiteboard. And I have a new one. The value is dividend in period 1 R minus G. Do you agree with me?
Yeah.
The problem seems to be that why the actual price is 40 and the theoretical price is 29 something. It could be that we need to revise, what could be the equilibrium rate of growth of dividend that the reality and the theory becomes equal. It means we need to check what should have been the right growth rate of dividend. Now, you can't say it for the future, but in the hindsight, when things have happened, retrospectively, you can find out. And this can also be very interesting thesis topic when you look at some companies' actual growth rate, CAPM, the theoretical price and the real price. And then you find that, hey, what should have been the rate of growth of dividend so that this anomaly would not have existed in the first place. But anyways, we know that the dividend grows at this rate, D0, 1 plus G. Agree with me? 1 plus G. And the denominator remains same. Can somebody quickly tell me, or maybe I can quickly look at, because otherwise 40, yeah. Are you guys still able to see the whiteboard in your screen?
Yeah.
Okay.
Yes.
So the current value is 40. How much is the current amount of dividend you pay? I think it's 2. Am I right? 1 plus G. And how much was the CAPM rate of return? Was it 12.2? Huh? So 12.2 means 0.122 minus G. So now it looks like a mathematical equation. And if you solve for G, can you do that or not? Can you do or not? Just basic equation. Solve for G. And then the G comes to be how much? G comes to be 6.86%. So if, for example, you are some astrologer and you knew that what can happen exactly in the future, then you could have asked this company to have the growth rate in dividend at 6.86% so that there's no deviation. There's no anomaly between the market price and the theoretical price. Yeah. But basically, it doesn't make any much sense in the sense that sometimes you want to find that what would have been the right decision retrospectively. We call it what if analysis. It's just a matter of curiosity. It's nothing more than that. So you're just curious to know that what should have been the rate of growth of dividends so that there would have been no difference in the real price and the theoretical price. Oh,
Now, can I ask you one question?
yeah.
For example, in the starting position of this example, there was written like the current dividend is $2 and it is expected to grow at 5% indefinitely. So is there any chance that we can calculate this 5% growth rate or no? So where we can take it, this one growth rate?
So even though it's indefinitely, but it still means that for each period, the rate of growth is 5%.
That's true, but like we can calculate somehow the rate of discount, it is CAPM.
Yeah.
But how we can calculate the growth rate?
The growth rate of dividend.
Yeah.
I think we can run some small show at some stage. that you can find the company's dividend from Yahoo Finance, the dividend data, how much dividend they have been paying. And for example, if you look at, usually the company pay a dividend either semi-annually or quarterly. Okay. So if they're paying you quarterly and you take last 5, 6, 7 years data, right? And if you find the average, so then you can find that the average growth in dividend has been this. So it's possible. In Yahoo Finance, let me show you, since you asked me, there's no guarantee that if I would be able to find out, but let's try at least. If you go to Yahoo Finance, let me see if I'm sharing the screen. Share screen, Yahoo Finance, yeah. Yahoo Finance. So if, for example, I want to see Marks and Spencer, let's say Marks and Spencer. Here, Marks and Spencer. Where is Marks and Spencer? Yeah, it's basically it comes in the food chain, but actually it's a retail store. Marks and Spencer. I happen to be an ex-employee of this company. Yeah, I used to work as a part-time in the menswear section in one Scottish town, Aberdeen. So I worked while I was a student of my master's in finance. So I used to be the part-time employee in the evenings.
Best store in the UK.
Huh?
I think it's the best store.
One of the best. But it used to be called a luxury store, but now I remember today I was remembering that I remember one customer came because I was working in the menswear in the night fill, and the store was about to close, and he came and he was a young boy, he wanted a shirt, and he selected a shirt, and when he saw the price, it was 15 pounds, and he threw it. He said, no, I'm not going to buy it. Come on. Is it the value? Is it the standard of Marks and Spencer? They're selling a shirt for only 15 pounds. I will not buy it, even though I like it. So, so it used to be a luxury brand, but not anymore.
We do production for them, Shab.
Sorry?
We do production.
I remember
yeah.
you said that you are doing some work for them. Yeah, Marks and Spencer, you can see in many stocks, but I would pick up LSE, the London Stock Exchange, which is the home stock exchange of this company. If I get the historic data somewhere, perhaps I can also find the dividend data as well. If I pick up the dividends only, and I apply it. Okay, historical prices.
They can be paying dividends for the time horizon, because maybe you can change the time horizon and they all like.
Yeah. There would be just a second, because they are saying that the adjusted price is adjusted for the dividend. So I'm looking for that which day there's a gap between the closing price and adjusted closing price. So I'm just looking at, and that would be showing the dividend. Well, I just try. I don't know if I would be able to find out, but if I don't find the daily price, and if I find the monthly price, let's say, or weekly. Does investing.com gives any information separately for the dividends?
Yeah, but Marks and Spencer didn't give any dividend in the London Stock Exchange
They haven't given?
for the whole history from
No.
1998.
Seriously?
Yeah,
How on earth?
That's very. It should be a good sign because of that growth number.
Yeah, but at the same time.
British. Okay, let's try British. BP PLC. BP PLC. Historic data. I'm just trying if it works, but since Daniil has asked me, so
I'm sorry, Shah.
no, I'm also intrigued to know, because I'm wondering if I can find only dividend prices, historic dividend price, dividend only. Let's see if we are lucky. Oh yes, look, we got it. We got the data of dividend they paid, right? Now from here you can estimate the growth rate of dividend. So if, for example, I pick up this data, yeah, and if I take an Excel sheet, and guys, if you don't see the spreadsheet, the new one, please let me know. I'll share my screen with you.
Students cannot see this.
Yeah, I will.
Spreadsheet.
Yeah, it's not opening yet. So just a sec, I'll share it with you. So, okay. New share is the Excel. And yeah, so now, because this data is given in the, so it's like in the descending order, so newest to the oldest, okay? I'll keep in mind. So it's 3 point, comma 9529, 9529. And then there is 37118. And then there is 37684. 39169. So if I want to find the growth rate, it would be the current dividend minus previous dividend divided by previous dividend. Yeah. So based on this very less data, I can say that the average dividend is basically very less. The dividend growth rate, if I convert it to percentage, yeah, so this is very less growth in percentage. So if I format to percentage is, yeah, so it's very less growth rate of, so this is, so in case of British Petroleum, this would be a G. Yeah, make sense? Yeah, the average of the last few quarters. Yeah. In fact, to get it more reliable picture, I would take at least 10 observations. I took only 4. So maybe if I take last 2-3 years, 4 quarters, so 4 times 3 years, 12 informations would be good estimate. So this can be called as a G in your valuation model so far. Okay. Where are slides? Yeah. And then I quickly take you now. I think you know what I have been doing on and off basis. So I quickly take you to the free cash flow method. Some researchers, they have a problem with this word dividend. Even though you remember we did one exercise in which a company is not paying dividend now, but it may pay in the future. But some researchers are still unhappy with this dividend thing. They say that, hey, what if the company doesn't even pay in the future? And we can't really estimate when would they pay dividend. Then they say that instead of using the phrase dividend, use the phrase free cash flows. Free cash flow is representing the amount of actual financial resources which company has its possession for the future growth. Can you see the bells ring? The free cash flow is an indication that how much financial resources a company has it's for the future growth. Growth companies usually don't pay dividends. It means this technique seems to be more tailor-made for those companies who are growth oriented. And they don't pay dividends. So you don't have to go in that dirty job of making some random estimate of dividend after 5 years. And what is free cash flow? The free cash flow basically represent excess of your operating cash flow over the capital expenditure. You get a cash flow from your operations. And now you need to go back in the management accounting that what is a cash flow? Cash flow is money going out, money coming in minus money going out. But one, we have the operating cash flow. Operating cash flow means you sell your products, you get the revenue, yeah? Minus you deduct all the expenses which you pay in cash. There are some expenses which you pay in cash, but there are some expenses which you don't pay in cash. So don't minus those non-cash expenses because the money is not leaving you, remember. See, I started business by two things, hypothetically. This example is very important. It will explain what I'm trying to say. When I started my business, I started with two types of expenditures, investments. First of all, I bought a computer. And secondly, I hired Daniil as my manager. On computer, if the working life of this computer is, let's say, 10 years, and I bought this computer for, let's say, I also bought some software, the whole package. Let's say my investment was 10,000 euros on buying a computer, server, all that stuff, all that, kind of sophisticated system. And I'm paying 3,000 euros a month to Daniil. 10,000, 10 years working life, 10,000 divided by 10 means 1,000. This 1,000 is called every year, which I show in my expenses, called depreciation. I hope you remember depreciation. Like when you buy a car for 30,000 euros, and let's say that your car's life is 20 years. So then it's in your books, you reduce 1,500 every year. Same thing I'm doing. But please tell me, if I buy this computer for 10,000 euros and the working life of this computer is 10 years, and I'm showing in my books 1,000 euros as depreciation, am I paying somebody this depreciation? Is money really leaving my bank account, 1,000 every No, it's only in my books. It's my book transaction. But when I pay 3,000 euros to Daniil every month, does money leave my bank account? Okay, in that case, both are operating expenses. I can't operate unless I have computer. I can't operate unless I have my manager. Both are operating expenses. But the expense of depreciation is a non-cash operating expense. But the money which I pay to Daniil, salary, is a cash operating expense. So it means that even though my profit is reduced by your salary plus depreciation, but my bank balance is only reducing by the salary which I pay to you. Because depreciation is a non-cash operating expense. That's what we do here. Look at the formula. We have the net income available. We plus non-cash charges. Can you see why we plus them? Because the money has not left the bank account. And then we also plus the interest expense. You know why? Because even though the interest expenses are a reality, we pay interest to the bank, but they are not our operating expenses. So we only include that income which is coming from the cash flows, free cash flow. Free cash flow represents how much resources you have. But we minus what? We minus our expenses on the fixed capital and the working capital. Fixed capital and working capital is an indication that how much you are future oriented. Why would you buy some machinery? Why would you arrange some money? Because you are planning to make some growth in the future. You want to grow. If a company chooses to remain where it is, it would never buy a new machinery. It would never arrange any working capital because it doesn't want to grow. Okay, so then these expenses, which are growth oriented, we adjust, and this money which we get is called free cash flow from the firms. I'll give you a hint. Those students who would be writing the thesis and they want to also bring in the discussion in the thesis the growth orientation of the company. Yeah, how much is company growth oriented? They can use this variable, free cash flow, divide by total assets ratio, as a variable, as a measure of their growth orientation. I use this variable quite often in my research, but I have been using so far intellectual capital, intangible assets divided by total assets, or R&D divided by sales. That is my traditional growth proxies or the growth variables. But I have recently discovered that this variable can be very useful variable in your empirical research. So you can consider calculating free cash flow of a company for a year, divide by its total assets, and that because why you divide by total assets, because you want to see the growth rate, not the absolute money. So this can be, as I wrote here in the bold letters, that this variable is very underused in the research. So in the empirical research, the free cash flow, in fact, I should have written that the free cash flow, FCF, divided by total assets. This ratio can be used as a very good measure of the growth orientation. When we do the thesis, we not only look at our research ideas and our research findings, but we also see that can we also add to some existing methodology? Are you with me? So sometimes you don't contribute too much to the research idea, but you create some new variable or new technique. That is not a less contribution. So yeah. All right, so I come back to straight away. So we use the same technique. See, this is just like the dividend Gordon's growth model, that instead of dividend one period, you have free cash flow one period. And how do you get the free cash flow in the one period? You find the free cash flow which is existing, multiply by the growth rate, and divide by what? Instead of R, what was R, by the way? CAPM rate. You take now WACC, the weighted average cost of capital. Now, please don't say that you don't know what is weighted average cost of capital. Do you know that? Weighted average cost of capital, we have done it. If we haven't done it, then I can show it to you. We have done it, but just in case you want to have a quick recap, what is the weighted average cost of capital? The weighted average cost of capital is WACC. Oh, what's that? Is equal to the return on equity divide by, multiply by what? Percentage of equity.
Weightage.
The weight of equity. And how do you find the weight of equity? You divide the equity by D plus E of the firm, the total value of the firm. And this in the bracket, which I wrote, is also called weight of equity. You're right. But how we find the weight is equal to equity divided by D plus E. And then you divide by, you add the cost of debt, but you multiply with 1 minus TC. You multiply by 1 minus TC. Why I do it? Because remember, we discussed last week that debt is tax-free. So if you pay 5% rate of interest on debt, and you pay 25% corporate tax rate, basically you are only paying 75% of 5%, because that amount of tax which you pay is only falling on the equity income, not on the debt income. So that is like a subsidy in a way, times amount of debt divide by the value of the firm, the book value of the firm, D plus E. And like E over D plus E, D over D plus E can be called as weight of debt. And when you combine with the CAPM, and this by the way, RA come from CAPM. This is coming from where? CAPM. And this RD is coming, where it coming from? It is coming from, often we see this word finance cost or finance expenses. So if you have finance cost, and where would you see it? In the income statement, finance cost. And if you divide it by total debt, and where do you see total debt? In the balance sheet, liability side, total debt. So by doing so, you can bring both equity cost and the debt cost, and then it becomes weighted average cost of capital. Question: why don't we have R in the free cash flow? Why we want to include debt also? Because for this, you need to know the formulation. And the formula is when we are calculating free cash flow here, we are adjusting for the interest expenses, the finance cost. So because the finance cost is included while calculating free cash flow, therefore we cannot ignore debt when we are adding the rate of discount. So in the new rate of discount, we have to give due respect to the not only the cost of equity, but also cost of debt. You also have to pay respect. So we take overall cost of capital, not the equity cost, not just equity, but the overall cost of capital. That's why we include, in this case, our rate of discount is not just CAPM thingy, but overall weighted average cost of capital. And G is same as before, the dividend growth rate. So it doesn't change. But this is a very important method. I really like it because it overcomes many limitations of non-dividend paying companies situation. I would even say that this free cash flow method is more suitable to the growth companies who don't pay dividends. Okay, sound sense? The rest of the formulation is same. Instead of dividend, we have free cash flow. Instead of R, we have WACC. Nothing changes. Nothing changes at all. So please try these questions, and I quickly move on to the, because I don't want to take this topic to the next week. So I want to quickly discuss the price multiples in valuation. We also use the price multiples in the valuation as well. Price multiples mean some kind of indicator, some statistics. And a very important statistics that we use is price to earnings ratio, or P to E ratio often. Price, you know, is the current stock price, and the earning, you know, that is the earnings per share. Price you see in the stock price in some, you know, on some website. The EPS you get usually from the income statement, even though in Yahoo Finance or these databases, you can also see EPS as well. Huh?
Like said, there are different data, not like the 4 years.
Well, why don't you go and see by yourself in the income statement, earnings per share? Of course, it should be in the income statement.
We didn't think about that.
Isn't
We did.
the earnings per share? Yeah.
Earnings per share.
Yeah.
Oh yeah, yeah. That's another one.
Yeah. If you know your net profit, which goes to shareholders, divide by number of shares the company has, and you find your own reliable information. Again, from methodology point of view, the price to earning ratio is also a very good indicator of the future. Try to understand the two components of this ratio. The numerator is stock price, and the denominator is the earnings per share. The numerator is futuristic, and the denominator is historic. Fernanda, does it make sense? The numerator is futuristic, and the denominator is historic. When you see the stock price of a company today, compare it with yesterday. The rise or fall in the stock price would be an indicative of the company future. If constantly, consistently, the stock price is going up, you can make some estimate or some, you have an argument that the company's future is good. But if over a time you find that the general trend, there are some good moments, but the overall trend, when you draw the trend line, the overall trend has been downwards. So it may mean that the company's stock, the company's future is not so bright, rather bleak. But when you look at the denominator, the earnings per share, it comes from your accounting books. Accounting books are not written every day. It's historic, it's history. Right now, you are in 2021. And you can't see the 21's annual report because it will be published in 22, that too in the middle of the year. There is always a time lag. There's always a history. Maybe these websites are calculating their earnings per share based on quarterly report. Could be possible. Some are including 1 quarter, 2 quarters, but even the quarterly reports are not published immediately. They also take time to publish it. Okay. So the denominator is history, past and future, and doing this thing today. So today you are combining future and the past. So therefore, it's very interesting observation. And once again, price to earning ratio can also be used as the company's prospects or the growth variable. Some researchers use the trailing price to earning ratio. Trailing means there's a time delay. And what is the delay? The current market price is divided by the most recent 4 quarters earnings per share. So you calculate 4 quarters earnings per share, you add it up and you take that one. In such calculation, the EPS is sometimes referred to as trailing 12 months. You often see this abbreviation TTM on the websites. When you look at the notes, TTM means trailing time is how much? 12 months. 12 months mean 4 quarters. So the delay, so you add the EPS of 4 quarters in the previous. But some are looking forward, prospective, and they are dividing the current stock price by the expected dividends. Tell me, did you see this phrase expected dividend today discussion, the entire discussion? Huh? The dividend growth rate? Is it what you mean?
Oh yeah. No.
Or is it that it was D1 is equal to D0 multiplied by 1 plus G? Yeah. So you see that how much dividend would be in the future, how much dividend would grow. So you can see both ways. Yeah. Even though I would say that mostly it's a matter of convenience also, perhaps. I often see the trailing rather than the expected leading. Trailing and leading. Leading mean, ideally it should be leading, but in reality, it's more convenient to pick up historic data. Look, I went to Yahoo Finance, checked Marks and Spencer. I got 1 full year's dividend data. So it's much easy to look at. And then some people also find that the price to earning ratio is not enough. We should look at actually PEG, that how much price to earning growth ratio, how much the price to earning is growing. But I forgot to tell you one thing. Price to earning ratio, maybe I know. I'm so scared of shiny. Shiny?
Yeah, Shab.
I'm exaggerating. I know you're never angry. Yeah. So price to earning ratio interpretation is that it shows that the relative valuation of a company. Let's say price to earning ratio of Marks and Spencer is 12, and price to earning ratio of the retail index, it means all the the industries in the retail sector in UK. So it's 12.37, let's say. And this is 10.05. So basically it means that to earn £1 profit or earnings, investor is willing to invest £12.37 in Marks and Spencer, whereas for the overall retail sector, to earn £1, maximum investor is willing to pay £10.05. The investor is willing to pay more to earn the same earnings from Marks and Spencer. But for the overall, the relevant industry or sector, the investor is not willing to pay on an average more than 10. My question to you, why would you be willing to pay more for some investment in comparison to other? What do you see? You see growth prospects. So you are over, you're putting Marks and Spencer on premium, which means that you know that the Marks and Spencer is likely to overperform the rest of the companies in the same industry. So it means Marks and Spencer is overvalued in comparison. So when you want to make some comparables, then price to earning ratio can be used as a very good indicator. So it shows the investor's faith with the company. And then we also have one PEG with the slide, which I quickly showed you, that you see the price to earning ratio of 2 periods and find the growth of price to earning ratio. Are you with me? And you know how to calculate growth, the current price to earning ratio minus previous price to earning ratio. And see, went up or down. Now 12.37 in comparison to 12.05 looks very nice. But what if in the previous period, it was 16.6 and the overall sector was still 10.05. So it means that in T0 period and in T1 period, in both periods, the Marks and Spencer's growth prospects are more than the average industry. Yeah, Daniel? But when you see the previous period, then investors' faith was even more. So technically, the investors' faith in Marks and Spencer has gone down in comparison. Does it make sense? So therefore, some researchers, they believe that just one P/E ratio is not suffice. You need to compare it. And this is called, this is what they call as price to earning growth PEG ratio.
Values the growth perspective.
Yeah. So when you look at time one, the growth prospects are still more than the overall industry. But overall, when you compare firm now with the firm yesterday or last year, then that overall relative confidence of investor has gone down. Yeah, it can go. Yeah. So
But the price is the same.
Whose price are same? Why would price be same?
We're just comparing the price, like the growth of the each one company.
But how does P/E comes? How can your P/E ratio change? Stock price change, EPS change, so something would have changed. Isn't so?
Oh yeah.
Daniel, how can price be stable? Well, it can be.
It can be stable.
So it will change. Only then you will have different P/E numbers. Sometimes you scare me, Daniel.
Sorry, I just so much data is like
Don't worry. No, it's fine. I understand. Okay. And then we have, for example, you can have an advantage of using PEG ratio is that it considers the future growth expectations. So it's not only looking at the expectations, but it also look at the growth of expectations. Okay. So for example, here you have two stocks. You have airline stock and tech stock. For the airline stock, the P to E ratio is 45. It's always times because it's P divided by E. For the tech stock, it's 18. The 5-year growth rate is 25%. So the P to E, the growth, the PEG would be 1.80. Whereas here, if you divide by the forecasted growth rate, it'll be 1.50. So you can have a better projection with the price to earning growth rate. And the last one is very, very easy, and rather it's too easy. It's called net asset value method. Net assets. How many of you can bring the visualization of a balance sheet in front of your eyes now? Can you? You, on the one hand of the balance sheet, have assets. Yeah. And then on the other side, you have the liabilities. And the assets minus liability is what? Equity. So equity is basically your net asset, isn't? If your liabilities are more than your assets, then the book value of your equity is 0, it means the company is bankrupt. You always see that the sum total of liabilities is less than the sum total of assets. Which assets? Current plus non-current. Which liabilities? Current plus non-current. And when the sum of your total assets is exceeding the sum of your total liabilities, the remaining figure is called total assets, net assets. You also call it shareholders worth, and you also call it shareholders equity. So basically you have shareholders equity, and this you divide by the number of shares. So basically, you add all the assets in the given example, you subtract all the liabilities in the given example, and then divide by the number of shares. A company have a portfolio of 75 million. There's a company, and this company has invested a lot of money, and the value of its portfolio is 75 million. Please tell me, is it a company's asset or liability? Investments are always assets. Financings are always liabilities. The cash and cash equivalents is 15 million. Cash or asset or liability? Asset. What is called cash equivalents? Cash, I know what is cash. You all know what is cash.
Obligations.
Huh? Cash equivalents. Cash equivalents are those which are almost cash. Not cash, bonds. For example, you can sell them quickly. Yeah. Or for example, it can also be bills or trade bills. For example, let's say I'm a company and I sold, and let's say Fernanda is my customer, my client. I sell something to her. She hasn't paid me cash yet, but she gave me a bill. She signed the invoice, and I need money right now. But I can't force Fernanda because we have a deal that she will pay me after a month. But then I can show that bill to the bank, and I can have some short-term funds arranged with that. So when after 1 month Fernanda pays me, I pay this back to bank, and bank release my document. Yeah, but I can quickly arrange cash. So this is called cash equivalents. Laurie said bonds. Let's say you also have some the government bonds. You sell them in the market. Fine. It's a little bit more inconvenient. It takes a bit longer, but it's very easily convertible to cash. Anyways, accrued income. Accrued income. Have you heard this phrase before? Accrued income is the income which has arisen, but you haven't got it yet. Your tenant should pay rent today, but he hasn't paid yet. But because it's this month's rent, it should be recorded in this month's income. So it's an asset because it's your claim on others. Are you with me? It's your claim on others. Same way it can be accrued expenses also, that now you are a tenant and you haven't paid rent yet. It's your liability, right? Okay, next, short-term liabilities and the long-term, the name suggests that they are liabilities. So we make some calculations and then we divide by what? The number of shares of the company. And in this case, there are 20 million shares of this company. So we divide it and we find out the net asset value price of the stock. So it means the theoretical price of the company is $5.05. So I don't see any problem with that. So total assets minus total liability. So basically, if you can straight away go to the company's balance sheet, look at the book value of equity data, because that is all. How do you find book value of equity? Assets minus liability. So it's all already calculated. You don't have to do it again. The shareholders' equity is already equal to total assets minus total liabilities. Divide by number of shares, that would give you what? The book value of the equity. And if the market value of equity is more, overpriced. If less, underpriced. As simple as that. So with this, we complete the valuation topic altogether. And in the references, in the recommendations, actually, I could have given you some very dangerous looking articles, but I haven't given. What I've given you is some of the theses which my students have done in the field of valuation in the past. They're very interesting theses. If any one of you ever think about valuation per se, or some dimensions of the valuation, then these theses can be super useful. Okay. Thank you so much.